This is the Skin in the Game VC podcast, hosted by Tom Wallace, entrepreneur turned venture capitalist and the managing partner at Florida Funders. You'll learn from the best about investing in early stage tech companies, so you too can gain the confidence and find the tools that help you succeed as an angel investor. Are you ready to get some skin in the game?
I welcome you to another version of Skin in the Game, our podcast from Florida Funders. If you're not familiar with Florida Funders, we're a hybrid between a venture capital firm and a network of angel investors. We have about 2,000 investors that invest alongside our funds. We focused on early stage tech investing, and PitchBook and CB Insights named us the most active venture capitalist in the Southeast last year and in Florida. Our goal with this podcast, Skin in the Game, we call it Skin in the Game because we invest right alongside our investors. And so that's how we always have skin in the game in every company that we invest in. And our goal with this podcast with our podcast is really to educate, inspire, and activate early stage tech investors. I would say what could be more fun? You know, we get to go to work every day and meet people that are trying to change the world, and hardworking young people, and it's so much fun and so exciting. It's a lot more fun than playing the stock market, I'll tell you that. So a couple other things. I'm going to introduce our guest here in a second. We have a lot of different guests that we have on from time to time. And our guest today is really a rock star in the tech world, and you're going to meet him in a second. We typically have guests on that are either investors or founders, or oftentimes both. So with that, I want to welcome Brad Feld. Brad Feld is the founder of Techstars. I'll let him tell you about that, as well as he's currently the partner at Foundry. He has quite an extensive background in technology, been at this for 3 decades, and is based in Boulder, Colorado, went to MIT. So obviously a lot smarter than I am. And he has been an active investor involved in the entrepreneurial community. He's written books. He's a blogger. He's a speaker. Brad, welcome. So excited to have you on the show.
Thanks for having me.
I thought we'd start off by, tell us a little bit about your journey. And did you grow up in Boulder? Are you from Colorado?
I didn't. I grew up in Dallas, Texas. I lived there till I went to college. I went to college in Boston at MIT, lived in Boston for a dozen years. Boston was very good to me, but it was not home. It never felt like home. Northeast never was like the place I wanted to live.
Uh-huh.
And my wife, Amy Batchelor, who we met in school, she went to college in Boston as well. When I sold my first company, I was 28, and I told Amy that by the time I was 30, we'd be out of Boston. And 2 months before I turned 30, she told me she was moving to Boulder and I could come with her. So we were married. So that was not a like boyfriend, girlfriend thing. That was, okay, yep, guess I'm going to Boulder. And we came to Boulder pretty randomly. She's from Alaska, and Northeast wasn't for her either. And kind of we figured if we didn't like Boulder, we'd just try something else. We'd been to Colorado a couple of times. She'd spent a summer here, as a kid, or a year here as a kid. I skied here a bunch. Yeah. And we were here 6 months. 6 months after moving to Boulder, we're like, yep, this is home for the duration. We love it here.
Well, it's a great place. And I want to come back around on Boulder and talking about COVID and post-COVID, because I think there's a lot of analogies between that and Florida and what happened, and as people moved out of some of the other areas during COVID. But we'll get back to that. You said you sold your first company at the age of 28. What was your first company? Tell us about that.
Yeah, it was a very, very creatively named company called Feld Technologies. A joke that I named it after my dad. We started in 1987 and we sold it in 1993. And it was a time period where PCs, personal computers, were starting to be used in business, but they still weren't really networked together. And they definitely weren't. There was no internet to connect them to in a commercial sense. Yeah. So software at the time, PC-based software at the time was, for business applications or anything that was networked was pretty weak. The databases were starting to emerge. So you had products like DBase and Docs that were starting to come out, but they were pretty weak sort of real applications.
Yeah,
but
I remember.
Starting to try to use personal computers for business applications. So we built a company that had, hired real software engineers. Our team was all people who really knew how to write software, but then we applied that to business problems, and we built a bunch of custom software, different types of applications for small, medium-sized businesses. And in that, we ended up having a couple of different categories of business types that we built software for. So instead of every time starting from scratch, we would build off of both the expertise and also in some cases some pretty meaningful code bases that we'd used in other projects. So that was the first business.
And did you have a product, or were you pretty much a software development shop?
No, we never really successfully had a product. We were a software development shop. That was our business. We tried several times to create actual products. One of them, and again, go back to the time frame, early 90s, we were in Boston, and the venture capital community in Boston was pretty significant, even back then. And it turned out that we ended up having a lot of customers who were VC firms. And we ended up writing a couple of different types of products for them, but one of them was a portfolio management product. So, prior to using our software, the way that most VC funds did their quarterly reports is they just entered all this shit into a spreadsheet.
Yeah.
And
can you imagine?
Oh, horrible. So we wrote real application for that, and that ended up being used at a number of fairly substantial venture firms, a number of which nobody uses it today, but which used it for a long time. And if you said, well, what's an analogy to it in today's market, right? It was a very poor functional equivalent of what Carta might do today for a venture capital firm. So we tried to spin that out. I have a business plan somewhere still for something we called Venture Source, which was VentureSoft, which was software for venture capital firms. And we ended up not ever really having success with it as a separate business, but we ended up getting a lot of additional consulting work as a result of sort of having that focus on it. So we tried a few other product-oriented things to try to turn them into separate products, but for us as a consulting business, it was always a trade-off between spending all of our time on the product and not getting paid for it, or getting paid as consultants, to build the software, for a particular company. And that was a very hard trade-off.
I've seen that over the years where companies are trying to be a services company and a product company. That's why I asked you about it. I've never seen anybody execute on that really well. Either they end up going all product or they stick with services. It's hard to do both those things, I found.
No, it's very hard. There are very, very few successes.
Yeah.
I do have a couple of examples, including a couple of friends' companies who were able to transition from consulting to product-based companies, but it takes real focus and commitment to do that.
Yeah. I think Basecamp did that. But so you sell your company, you're 28, you moved to Boulder. What next? What happened next?
Well, between 28 and 30, I was I worked for the company that bought mine, and I started.
Who did you sell to, Brad?
I sold to a public company that ultimately was called Ameridata Technologies, and they got bought by GE Capital in 1996.
Okay.
So during that period of time, I worked for that company. They bought a bunch of companies. I'd never done any transactions, buy, sell, or invest in anything. Mm-hmm. And I ended up being the technical guy on the deal team. So I got to work with the two guys who are the co-chairs of the company who were doing lots of acquisitions. And so I learned a lot just by observing them and participating, in what they were doing. Mm-hmm. At the same time, I took most of the money that I made from selling that first company. This is 1994, 95, 96. And invested in about 40 companies as an angel, so about one a month. And
wow.
we moved to Boulder in 1995, so it's kind of right in the middle of that was when I moved. But I was investing all across the U.S. I had a big network in Seattle because we'd done a lot of work with Microsoft in my first company. I grew up in Dallas, so I had network there. Boston, I'd lived in for a long time. New York, I had a network there. I had a network in the Bay Area. And so my angel investing activity was kind of everywhere. And when I started, I'd never made an investment before, so I learned by doing. Uh-huh. Along the way, I ended up getting connected with this little-known, at the time, Japanese company called SoftBank, that was just starting to do stuff in the US.
Yeah.
They bought a couple of companies, Comdex probably being the most notable, and maybe Ziff Davis was also the most, equally notable. But they were very aggressively starting to invest in what at the time was called digital media companies. And there was a group, a very small group of people that were working for SoftBank that went looking for people to work with as affiliates, to basically help them find deals. The thing that today we might call a scout program.
Yeah. Mm-hmm. So what I was thinking of.
And I started making investments where, I would invest my own money in the stuff that I found, but they would invest their money too in some of it. And when those deals paid off, I got some economics on the money that they invested. And that was really my intro to venture capital.
Did you meet Masa's son?
Yeah, I met Masa a couple of times. I don't have a close relationship with him. I think Masa would still, at this stage, be able to pick me out of a lineup. But I would say for the first couple of years, we were really the team that we ended up being, which then the group that we were part of, that I was affiliated with, raised our own fund that SoftBank sponsored. And at that point, I became full-time VC, but as part of the SoftBank investing activity in the US. For a while, we were the primary US investing activity, and then that evolved from there. But Masa was fascinating, and the 300-year vision he talks about today, it's probably only a 280-year vision, because 20 years ago it was a 300-year vision still. And a lot of the activity, both positive and negative characteristics of the activity that we experienced in the internet bubble, were not that dissimilar to the dynamics of what's been going on the last couple of years here in this part of the cycle. And one of my narrative jokes is that a lot of the stuff that we went through or that SoftBank's going through today is basically the same dynamic, just 2 more zeros at the end of every check. Mm-hmm. So the quantum of capital being 100 times more. But
yeah, it seems I make that that connection with, it seems like the .com bust would that happened in like 2000. It lasted a couple of years. It seems to me like this crypto winter is kind of the same thing. It reminds me of that. I don't know if it's going to come back, and who can predict the future, but I do think, Web3 is for real, and I do think it'll come back. I just think it's going to take a couple of years like it did in 2000. What are your thoughts on that?
I think what just happened in the last 12 months, and really a little bit longer, because I think the peak was, from my frame of reference, the peak was really November 2021, is we really did go through and have gone through the same kind of, not just in crypto, by the way, but across all of tech.
Yes. All cloud.
The same dynamics that tech went through in the internet bubble, with valuations, public valuations, getting re-rated by 50 to 75%, in some cases, 90% plus, private markets. I think we're just now still at the earlier stages of the unwinding of so much overfunding. And things are blowing up in lots of different ways. Sometimes they blow up because there's no additional capital. Sometimes they blow up because there's fundamentally no underlying business. There have been a handful of cases so far that have been fraudulent, and there's going to be more that come that where it's just very, very clear that the activity was fraudulent activity. Mm-hmm. And I think at the same time, a lot of the similar narratives existed. The internet bubble really crested in the spring of 2000. And so 2000 was much like how I'd say the first half of maybe the first, from fall of 2021 to fall of 2022 mm-hmm. was kind of what things felt like spring of 2000 to spring of 2001. And in 2001, and maybe summer 2000, like the time frame doesn't line up exactly. The narrative at the time, you heard a lot of things like, if you've got a lot of capital, you'll be fine. You need to be capital efficient with your company. You need to start to focus on the actual metrics of your business. There's lots of capital, dry powder on the sidelines that's going to have to go into these companies. So there's going to be a lot of capital, But what changed then, which I think we are in the beginning of, is there was a real fundamental shift in 2001, 2002, 2003, and even into 2004 and 2005 around how capital was deployed and how companies both grew and continued to not have access to capital and subsequently fail. So I think this year, I think 2023 will be a pretty rocky year. We talk about it within Foundry as being murky. Like we're not predicting, what's going to happen.
I like that, murky.
We kind of don't have a fucking clue.
Yeah.
But plan not that, oh yeah, well, the crash is over and now everything's going to be fine again. And don't subscribe to the common narratives that everybody has, which is you should do this or you should do that. But instead, as an entrepreneur, really focus on your business and understand, things like line of supply, like, what kind of capital will you need, when will you need it, and where are you going to get it from? And if you're in a position where you don't need to get any additional capital, either from equity or, any other sources because you're cash flow positive or you've raised a ton of money, make sure that you're in a position where you get more capital well before you're in a position where you need more capital.
It's a bad time to run out of money, cash right now.
Yeah. And, you say, well, I got 2 years of capital because of how much I raised. That's fine. 2 years is good. 2 years is better than 1 year. But, if you looked at the amount of capital that you raised, did you raise so much money that really 50% of the money you raised, you can just set aside and not even think about it and say, well, if I take half the money I raised, I've still got 2 years.
Mm-hmm.
Organize your business around building a much more durable business. I would say in the internet bubble, the companies that did that and really readjusted everything about how they thought about what they were doing against a very different kind of market dynamic were the ones that had a lot more agility to navigate their way through the next couple of years versus companies that don't create a situation where they have some agility to continually reevaluate the environment. Just one other caveat on that, hard lessons learned from life is, many companies, and we're just into 2023, so people have set up their 12-month plan. You've got your 2023 plan. You said, how accurate is your Q4 plan? If anybody says anything other than it's complete random number generator, they're lying. There are so many things in our macro economy. There are so many things that are ripple through effects in different parts of our global economy. There are so many different things going on within technology, within local communities, within local geographies. Many things people say, well, the supply chain problem's over. Well, actually, the supply chain problem's not over. If anything, it's gone the other direction now. There's a massive oversupply of manufactured goods that are now coming, into places that have normally been significant consumption regions like the US of those things. And so, if you've got a massive oversupply of things and you've got inflation, that's theoretically driving prices up, well, those things counterbalance and prices will actually come down for certain things because when you have a whole bunch of excess inventory, you don't want to carry that excess inventory because the cost of carrying all that excess inventory is higher. All of these things are things that if you're a startup, you say, great, Brad, yeah, but I don't care about any of that. Yeah, but it's going to make your customers harder to find, and it's going to change the dynamic of what appropriate cost of going to market with different things are. It's going to change cost of labor, probably for the better, where it'll be less expensive to hire people. So all of these things, if you're planning on an annual basis, you don't have an aperture for any of this stuff.
Nobody really knows, right?
Nobody really knows. And I like to joke, in my first company, we didn't raise any money. So, our planning horizon was like a day.
Yeah.
It was really every 2 weeks we had to make payroll. And then, we kind of had a monthly planning cycle and, we would reflect on things at the end of a year. I think most startups, angel-backed, venture-backed companies, the right planning horizon here is to have a continual 12-month view that's forward-looking, but that you're really planning on a quarterly basis. So at the end of Q1, in March, April, you're making a plan for April of 23 to the end of March 24. So you're just kind of continuing to move that 12-month window. But you're really concentrating on what the current reality of things are at March 31, how things went against what you thought they were going to go over the last quarter, and are able to continually adjust the rhythm of your business.
That's the part I think so important, especially in cloud computing. We do a lot of SaaS investments. And the beauty of the SaaS model, and I ran a SaaS company for over a decade, is you can adjust pretty rapidly, and particularly in terms of hiring. Like if you put together your hiring plan, to your point, if you don't make Q1, you don't make the hires in Q2 that you were planning on hiring. You can dial that back. And you know, I think that's one of the advantages of the SaaS business model, that you can always invest less in sales and marketing, grow less. You can give up growth for profitability, right, or for cash flow. And I noticed that I think in one of the articles I read, you were talking about the rule of 40%, and it made me think of that. Do you want to tell the audience what that is?
Yeah, the rule of 40 is sort of the threshold that now has become conventional wisdom. That is the acceptable threshold for essentially a SaaS company, when you do the math of the two numbers being your growth rate plus your growth rate percentage plus your EBITDA percentage. Mm-hmm. So, you know, if you're growing at 40%, you should be break even. If you're growing at 60%, you could lose 20%. You know, on an EBITDA basis. If you're growing at 20%, you should be positive 20% on the EBITDA basis. If you're growing 100%, you could be minus 60% on an EBITDA basis. The interesting challenge, I think, for a lot, there's two parts for SaaS companies where this is an interesting challenge. One is, for the last couple of years, people have been prioritizing growth over everything else. Mm-hmm. And there's a bunch of other SaaS metrics where this shows up, right? A lot of people have talked about how, you know, the payback on a dollar of, let's say, I want $1 of to acquire $1 of growth. How much money should I spend, and what should that payback period be? And it used to be that the payback period was like 12 to 18 months, and then it became 24 months, and then it became 36 months. And you know, so what that did was allow people to spend more and more money for $1 of ARR. If my payback period's 3 years, I'm willing to spend $3 for $1 ARR, and that doesn't work.
Yeah, I don't like those numbers.
No, and in fact, what you just saw in the public markets is a bunch of SaaS companies, including some that, you know, were extremely well regarded. Their CAC has gone up so much that their payback period's now 10 years. So, you know, I'm paying $10 to get an incremental $1 of ARR. That doesn't work.
Yeah.
So then there's another part of it, which is so many companies, based on the growth of tech and the number of tech startups and the growth of those companies, and then the adoption of multiple, you know, SaaS products, many SaaS products in these companies, meant that NDR, net dollar retention, once you had an existing customer, was meaningfully greater than 100%. We have companies in our portfolio where, you know, 1 year net dollar retention would be 150%. Some companies where 2 year net dollar retention was over 200%. You know, so you get a compounding effect of the NDR. Well, if everybody's laying people off across all of industry, mm-hmm. and you know, they're looking to save costs, including within the technology industry, which is a big consumer of technology products.
Sure.
Many SaaS companies are, you know, your NDR in 2023, pick your time unit, is going to go, you know, from greater than 100 to less than 100, which means that you're now starting with a lower, you know, yes, it's predictable, but you're starting with a lower amount, starting point to get back to where you were before. And companies don't have the muscle for making this analysis, right? And management teams have been operating, and financial plans operating, under the assumption that NDR is greater than 120%, and that when you start looking at these and say, what is an acceptable amount for me to be spending to get whatever growth I'm getting? Things like the rule of 40 are useful heuristics, especially at mid-sized and scaled companies, just to give you a way to center as to what an acceptable pace is. But more importantly, it's to recognize that a lot of the underlying assumptions that fueled spending money ahead of getting customers because of the compounding future value of those customers are now working against you in a lot of those companies. And there's lots of ways to adjust for that, but you know, the last however many years, 4 or 5 years, maybe 6 years in the B2B SaaS world, there hasn't been a lot of focus on that. So I just warn people to, again, be aggressive on the front end, and then be agile about how you adapt based on what's happening in your current reality. If you're finding your NDR is continuing to expand because your product is a must-have, and even if people are cutting headcount, you're getting more deployment within your existing customers, that's awesome. Yeah. But you're in a very different place. And if somebody whose product is not as much of a must-have, and I mean, I'll give you an example. We did an analysis within our portfolio, and we looked at how much each of, it was about 50 companies participated, how much they were each spending on, how many employees they had, how much they were spending on Google, Slack, and Zoom.
Mm-hmm.
And then there's a fourth category. There were a handful of companies that were spending on Microsoft products, Office, Team, Office 365. And the number of companies, if you looked at the efficiency curve, the number of companies that had chosen only one of those products and was only using one of them or paying for one of them, they might be using Zoom for free and using Google as its primary thing. Those companies had a much lower cost per employee by, in some cases, a factor of 5 to 10. I think the range was like $1,200 per month per employee, and the low end was like $100 and something bucks per month per employee. Against those products, it's pretty dramatic. If you have 20 employees, who gives a shit? But if you have, although it's still non-trivial, but if you have 2,000 employees, it matters. Like, tell me again why I'm using all these things.
I think it even matters with some smaller companies. I mean, you look at Salesforce and look at, how much money, Salesforce starts out cheap, as I'm sure you know, and it goes up pretty rapidly per user. And before you know it, your Salesforce bill every quarter is quite a chunk. Hey, Brad, this is great stuff. And I wanted to go back to you. I'm kind of curious on this personally, because I've been an angel investor going back several decades as well. You did 40 investments with the money you made from your first company. How did those turn out? That's a really nice diversified portfolio, right? I mean, I think angel investors, we tell our investors, hey, do at least 10 or 15 deals, or you're not diversified enough, and you're not going to maximize your potential returns. I'm kind of curious on that.
Yeah. So again, put it in time context, 94 to 96, it was kind of crazy for somebody to be doing, that velocity of investments. And the way I looked at it, I'll tell how it turned out, but the way I looked at it was, I was going to invest the same amount of money in every company. And I ended up evolving a rule where I would sometimes invest that check again in a company if it had made progress but hadn't gotten to a place where it could raise another round. And
so you do follow-ons.
But I was very quick to invest if the company needed another check at the same terms of my first check to get to that place where they had the ability to raise money from additional investors. But then I didn't play my pro rata. I was an angel investor. I was done. And so my check size was $25,000. So I was very consistent. Maybe 15 of the 40 companies, I ended up having 50 grand instead of 25 grand. If you break down that portfolio, I had 3 companies of the 40. Each company by itself returned more than 100x.
Wow.
So if all the other 37 companies were zeros, I did great. 20 of the companies were zeros.
Okay.
And the other 17 returned something to me. And I would say that probably the median of what I got from those other 17 was like 2x, not the average, the median. If you take the tails off, it was probably a 25x one and a 10x one, and a handful between 5 and 10x. But most ended up being between, I got most of my money back and I doubled my money. And then there were some where I got, a tenth of my money back or 20% back or something like that. And essentially that group of 17 roughly returned the total capital that I'd invested. And then those 3 were the real significant outlying returns.
Over what period of time?
3 years.
3 years.
I mean, that was when I committed the capital.
Is any of the 100x, would we recognize any of the 3 companies you hit 100x on?
Hope so. One was, if anybody out there has ever played Guitar Hero or Rock Band, it was a company called Harmonix, which is the company that essentially, with one other, there's 2 companies that created Guitar Hero, them and another company called Red Octane. They then went their separate ways, and then Rock Band was created by Harmonix. And that's a good example. That company, I think I funded, it was a 5th company I funded as an angel. It was in the first 5. I'm pretty sure it was the 5th one. And they tried their hardest to go out of business every year for a decade. and just managed not to. But they, for every year, they just somehow managed to stay alive. And then, then they came out with Guitar Hero, and it was a massive win. Another one that if people are old enough, they'll remember is a company called Critical Path. Critical Path was, I think it was really the first email hosting business of scale. They were commercial email hosting versus like what Hotmail became, where it was individual.
Okay.
Email. But if you were a company and you wanted to host your internet email box online, they were really the first, and they grew very, very quickly. It was extremely successful business for a while. I think the peak market cap as a public company was about $5 billion when that was a big number.
Yeah.
And in the end, they really struggled and they had some issues. But as an angel investor, like they went public, and 6 months after going public, I would say I now have a very consistent strategy for what I do. At the time, it was a little more chaotic, but I would always sell a meaningful chunk of whatever I got once the lockup came off. So at least I had, some of the gains locked in. And then I didn't have a formula in 2000 for what to do with the rest, but over time I started to figure out and develop a formula for what to do with the rest.
Okay. Let's talk about Techstars. You were one of the co-founders of Techstars, and I'm guessing some of our audience, angel investors, know of Techstars, and probably some don't. Why don't you tell us a bit about that and how you got involved with Techstars and how that got going? Because Techstars, for anybody that doesn't know, is very well known. Y Combinator, Techstars. I mean, it's one of the top incubators, accelerators, and out there.
Yeah, so we started Techstars in 2006. There were 4 founders. David Cohen, who really came up with the idea. He had a business partner for many years in a prior company, a guy named David Brown, then me, and then a longtime friend of mine, Jared Polis, who then became congressman. He was a very successful entrepreneur, became congressman for Colorado, and then is now our governor. And the 4 of us started it just as a 2006 timeframe was one where entrepreneurship was still very much on its back. The internet bubble hangover, however you want to describe it, hadn't sort of come back. Web 2 was starting to emerge, and there was starting to be some interesting stuff happening again. Obviously, in that time period, some really meaningful companies got created. But it was still, sort of a very, not an important part front and center in what we're doing. And, we all just wanted to get more involved in starting more companies. So we ran a program in Boulder that was what today would be commonly called an accelerator program. We funded 10 companies. The money was all our own money. And we didn't know whether it was a good idea or not. We decided that our worst case is we'd make some new friends and we'd have some fun in Boulder that summer. The key initial innovation that we had was we surrounded those companies with mentors, and we really created this concept of a mentorship-driven accelerator. So we had about 50 mentors in that first program.
Where did you get the mentors?
Well, the internal joke became, for the people that remember Bill Clinton, there was a thing called FOB, which was Friends of Bill's, who were always sort of getting jobs and hanging around and being part of the Clinton administration, for better or for worse. Here they were Friends of Brad. So I reached out to a bunch of friends, entrepreneurs that I knew in Boulder, but also that I knew on the West Coast and the East Coast. A handful of investors that were super early stage investors, including some that I was an LP in their funds, and they were starting new funds to sort of get this next wave of entrepreneurship going. And it was pretty amazing to have this experience where, we were involved in helping 10 companies get started, but also really reconnecting in a substantive and active way this startup community, this group of people who cared about entrepreneurships, but had them doing things with each other rather than just coming to cocktail parties, right? Helping companies. Many of them became angel investors in those companies that they were mentors for. It sort of emerged from there. And when we started Techstars, we really had no vision of where it would go. Today it's a global activity. We have, as a company, I think we fund about 600 companies a year now.
Wow.
We have 50 programs a year that we run. We have about a dozen companies per program. We're in 40 cities around the world, dozen continents.
With no vision.
We had no vision at the beginning. I mean,
That's incredible.
The vision we had was, we think entrepreneurship is really important, and we think anybody should be able to be involved in entrepreneurship anywhere. Let's try to do it in Boulder, Colorado, and make this a really substantive place where people can create companies. That was the vision. The outcome vision of what Techstars has turned into was not something that, we started with.
Brad, I got to tell you, Techstars, I mean, for no vision, and I know it had to change over time, where you guys have taken that, what Techstars has grown into, all these cities, 600 companies a year. It's very, very impressive. Congratulations. I wanted to visit a little bit, Florida, we really, and you're probably aware of this, benefited a lot from COVID. Our governor was very open. We really never shut down much as a state. Tons of people moved here from New York and San Francisco and all those places, both entrepreneurs and venture capitalists and private equity folks. And a lot of them have decided to stay. I'm curious, did you see similar thing in Boulder, and how did COVID affect the Boulder tech ecosystem and where you're at?
Yeah, I mean, the evolution for Boulder and for Denver predates COVID significantly. So, the arc's important to sort of get in the mix, because 2010, Boulder's a very small town. Boulder's 100,000 people, and Boulder County is only 250,000 people. Just for comparison, Denver is sort of the area immediately around Denver is about 2.5 million people. And Boulder and Denver are about 30 minutes apart by car, maybe 45 if there's some traffic. And so the important thing to recognize in that is, in 2010, Boulder's about a tenth the size of Denver. But by 2010 already, we probably have more startups in Boulder than we have in Denver, at least by a factor of 2, maybe more.
Wow.
So there's this very vibrant startup community that was being developed. Techstars was a part of it. It was not the only thing, but it was a part of it.
I'm sure.
We were having a lot of, it's hard to move to Boulder, because Boulder, I mean, there's been, movement to Boulder in the surrounds, but it's not a fast growing city because it's physically constrained in terms of the total population. So there's a very interesting dynamic that happened, which is that Boulder and Denver, as adjoining communities, really fed off each other. And, some good examples of companies, a public company called SendGrid, which started in Boulder, another public company called Zayo, which started in Boulder. Both of them expanded to Denver, and their Denver offices, I think, were pretty quickly bigger than their Boulder offices, even though they'd started in Boulder. And they really, kind of those two communities were reasonably well connected. What played out over time, and I really wrote about this in my book in 2012, a book called Startup Communities, was this premise that you could create a startup community basically in any city that had at least 100,000 people. And I made the assertion that not only could you, but you needed to, that every city that was wanting to be long-term vibrant needed, as part of the core of the city, it was not the only thing the city needed, but it needed a vibrant startup community. It needed this innovation activity, this company creation,
absolutely,
all of these dynamics to play out in a very significant way. And so I would say, over the course, in 2012, there was still the narrative that, like, if you're serious about starting a tech company, you should move to the Bay Area. Anybody else is not serious. And the whole unicorn language that started in 2013, a lot of that was, well, the unicorns are in the Bay Area. And of course, 10 years later, that's nonsense. Like, if somebody says it today, they're not credible. But in 2012, it was still a kind of a credible statement. And my argument was, no. Entrepreneurship is going to be democratized, not just across the US, but globally. And that was happening at a very fast clip. And then I think COVID, basically just took the snow globe and shook it, right? Because it's like, where do you want to live? You can live anywhere you want.
Yeah.
And, you can imagine the snow globe after you shake it, it's got the snow like bouncing around everywhere, but it eventually settles down. And a lot of people said, why am I living here? I don't want to live here. Or I'm working remote all the time. I can work somewhere else. And then you started to have this natural flow of people into other geographies, independent of where the employers were, that then unleashed, I think, this very powerful wave of people realizing, we can really build very substantive businesses in different geographies because of the interconnectivity that we just leveraged living through and surviving COVID, where we literally couldn't get together. We had to do everything remote. And there's advantages and disadvantages. to remote versus in person and hybrid, and people can argue and debate that shit all day long.
Yeah.
But it's pretty undeniable that geography is no longer the same kind of constraint to entrepreneurship. And then the inverse of it is that you have these massive startup communities in different cities, whether it's a big city like Miami or a smaller city like Tampa, that are growing very, very quickly. And when we moved to Boulder, I said at the beginning of the story, I mean, Amy and I moved to Boulder and chose Boulder not because of a business opportunity, but we just chose a place to live. Mm-hmm. And I've had this long belief that you should choose where you want to live and build your life around it if you have the ability to do that. A lot of people don't. So I recognize
that's a good philosophy.
But if you have the ability to choose where you want to live and then you build your life around it, you're going to have a much more powerful, more happy, more robust life than if you're living in a place that you feel like you have to live because of job, career, financial constraints, whatever.
That's wonderful advice. That's wonderful advice. Yeah, what we saw in Florida, because we were so open, we saw people come here. Some of them returned, went back to New York, went back to California, but a lot of them stayed, both because remote work now, you can work from anywhere. But I think a lot of them fell in love with Florida. They fell in love with our weather. They fell in love with the openness of Florida. They fell in love with the inclusiveness, the diversity, and some fell in love with the lack of taxes. That too. So.
And look, those are all good. Like the neat thing about, and I think it's a very powerful thing about the U.S. is that you don't have to get a visa to move between states, right? You don't have to apply for citizenship in another state. This notion that you can choose where to live and that the states have different characteristics based on, both the natural resources of the geography, but also the political culture, the norms that get created within the state. Every state has positives, every state has negatives. I grew up, again, in Dallas, Texas. There's lots of things about, Texas that I like and lots of things about Texas that I don't like. Mm-hmm. And when you say, do you like living in Colorado better than you like living in Texas? My answer is, yeah, totally. And well, is it the skiing? Is it the this? Is it the that? It's like, there's a long list of things. Uh-huh. And, is there anything about Texas you like better than Colorado? Oh yeah, totally. Right. So it allows, again, in the context of being an entrepreneur, if entrepreneurs have the flexibility to choose where they want to be based on their desires rather than, hey, if you want to be an entrepreneur, this is the only place to do it. I think that makes for so much more of a powerful.
Oh, no question. And similar to your story, I mean, startups here used to feel like they had to move to the Valley or they had to go to Boston. They don't do. Now there's plenty of capital, there's talent.
That's right.
So it's all been good. We're running out of time. I wanted to touch on your new book. You mentioned your previous book, Startup Community. Tell us, you have a new book out. Tell us about that. And what inspired you to write that?
I came out with a second edition of a book called Startup Boards that I wrote in 2013, came out with it last year. And it's really about it's aimed at an entrepreneur with the entrepreneur voice, but it's relevant for any investor or anyone who wants to be a board member or is a board member. And, it's really sort of hard-won lessons from my own experience about how to build effective boards for startups. And I think it's particularly true in 2023. There was a lot of dynamics that played out in the last 4 or 5 years where the board dynamics, corporate governance, the way startups thought about boards, when boards got formed, how the boards were configured, the responsibilities of the boards vis-a-vis management and the founders. Like there was a lot of, I would say, hand-wavy and laxness on that. Mm-hmm. And a lot of lazy behavior. And, there's plenty of problems that are emerging as a result of some of that. There's also a lot of situations where, boards are very poorly configured. I'm not a fan of venture heavy boards. I think boards should be balanced between VCs and outside directors and founders, mm-hmm. even at earlier stages. And, the best line I've ever heard about a board was from Jeff Lawson, who is the founder of Twilio. And Jeff said, I view the board as a second team I get to have. I have my leadership team and I get to build my leadership team and I get, our goal is to build super productive business, but I get this bonus team, which is the board. And yeah, the board can fire me. I totally get that. That's one of the responsibilities or capabilities of the board. But as long as I have it, why not build another amazing team and really get the board to function as a team to help me build and grow the company that I'm leading? And I think applying that to how startups work, but doing it in a startup way, that fits with startups versus just, the way people think of public company boards or nonprofit boards. Like, we tried to get underneath the skin of that in a significant way. I'm really proud of the second edition. The first edition was an okay book, but I wasn't super proud of it. I felt like at the end I was just pushing to get it done, and I was just struggling with the writing of it. And it's hard to write a book about boards and not have it be boring. But this book felt satisfying.
Well, I will look forward to reading it. I'll pick up a copy, and I'm sure some of our audience will as well. Okay,
Thanks.
lightning round. We're going to wrap up with 7 quick questions, just 1 or 2 two-word answers. Who's your role model? Or do you have a role model?
I like Einstein.
Okay. Favorite spot to hike in Colorado?
Aspen.
Favorite place to ski in Colorado?
I don't ski anymore.
Oh.
But Aspen.
Aspen too. Your favorite podcast?
I am not a podcast listener because I learn by reading, not by listening. I know that's more than one answer.
No, that's good.
So, but I'll recommend 2 podcasts that I do listen to periodically when I find a person who I like being interviewed. One is Tim Ferriss's podcast.
Yeah, that's good.
I've always been friends with Tim for a long time, but I always thought he was an incredible interviewer. And then David Cohen and I do a podcast called Give First. And I say that really, David mostly does a podcast called Give First, and sometimes I host it. But it's 30-minute interviews with people around the Techstars system. And some of the episodes have been really, really excellent.
Great. Favorite way to spend your downtime?
A couple ways. I love to read. I love to run. And I love to hang out with my wife, Amy.
Great. Are we going into a recession in 2023?
I don't even know what a recession is. I don't know what it means. I think it's looking backwards economic nonsense. Is 2023 going to be more murky in terms of what things are? Yeah, it's going to be way more murky, but I have no idea how to even define a recession anymore.
Brad, this has been great. Thank you so much. I'm sure our audience is going to love hearing this and learning from you. That's a lot of what our podcast is about, is learning from other investors. And you're obviously very experienced in a wealth of knowledge. I can't thank you enough for being on the show. For our listeners, if you're interested
I want to answer my last question again, because some knucklehead that's listening or some smart person that's listening and say, that guy's so stupid, he doesn't even know how a recession is defined as. Oh, I totally know what a recession is defined as. My point is, I think it's irrelevant in the context of entrepreneurship, because things are changing. If you caught the beginning of this, things are changing so quickly that by the time that we have the mathematical definitions of it, your behavior as an entrepreneur will have to have changed so much anyway before that. So I want to sort of answer tongue in cheek.
That's how I took it. A lot of great companies were built in recessions, right? Or came out of recessions. So for our listeners, if you're interested in getting more involved in Florida Funders, go out to floridafunders.com. If you're an entrepreneur, we have a way to apply for funding. Take you 5 or 10 minutes. You'll get in our process. If you're an investor, we have companies out there that you can invest in and look at. And we're happy to welcome you to our community of angel investors. So with that, sign off. Thanks again, Brad. Have a great day. Appreciate it. And thanks again.
My pleasure. Thanks for having me.
Thanks for spending your time with Skin in the Game VC today. If you want to learn more about investing in early stage tech like a venture capitalist, be sure to visit the Florida Funders website at floridafunders.com. Join our angel network at no cost and get access to Florida Funders VC vetted investment opportunities in the next great breakout tech companies.